Joining us from New York, we have ECRI's Managing Director, Lakshman Achuthan, joining us on the program. Lakshman, 17 months or 15 months since the the recession ended in June 2009. Why did it take so long for this to be declared?
Well, actually, it's kind of normal for it to take a long time because the National Bureau is just not in the forecasting business. They really are the record keepers of the peaks and the troughs in the business cycle history, in the annals of business cycles, as it were. So they're not in any rush to make a date or a call of a peak or a trough, in this case a trough. And in fact, they've actually sped up a little bit. It only took them 15 months this time to recognize the end of the recession. In the previous recoveries, it took 20, 21 months for them to see it. And part of the reason why they were able to see it, I don't really think anything changed other than the data was a little more clear this time, sooner. We have GDP, for example, has recovered 70% of what it lost during the recession. Industrial production, retail or sales and income, they're all up about 50%. The outlier, and I think the thing that held them up, obviously, was jobs. We have only recovered 9% of jobs.
The average American, they can hear that the National Bureau of Statistics or Economic Research saying that the recession ended in June 2009, but is the average American really feeling it?
Absolutely, and those numbers show it. GDP has recovered 70% of what it lost. Jobs, private sector jobs, have only recovered 9%. There's the disconnect between what people on Main Street are feeling and, a business cycle date. Remember what a business cycle date is. When they say the end of recession was in June of 2009, all that means is that the economy moved into the recovery room. It made it to the recovery room. But for anyone who's ever been in a recovery room, it still really, really hurts. You're not feeling good. You're feeling quite bad. And we remain in the recovery room in particular with respect to the recovery in jobs today. And it's going to take a long time, as people have discussed before.
Lakshman, we're still seeing GDP numbers coming in weaker with each and every quarter, so it looks like the recovery is slowing. What about this talk of double dip? You said that the chances are still 50-50, even though some have pulled it off the table already?
Yeah, it's premature to pull it off the table, I would say, but, that's what a market does, is they speculate one way or the other. Basically, the leading indicators, which forecast these recessions and recoveries, the growth rates of these indicators turned down very clearly at the beginning of the year, forecasting a slowdown in growth. Not a new recession, but a slowdown in growth starting by mid-2010. And as you say, we're seeing GDP already in the second quarter coming down, jobs growth coming down and slowing from already weak levels. So this is definitely a concern. Every time there's a slowdown in growth, there's about it's a 50-50 chance that slowdown turns into a new recession. So we look at leading indicators to tell us which way is it tipping. And right now, the jury is still out. It has not veered one way or the other. I think it's premature to call a new recession as a result.
Okay. All right. Lakshman, thank you for that. So we're still not out of the woods just yet. Lakshman Achuthan, ECRI's Managing Director.